Good morning and welcome to this Wednesday, November 9th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, futures are currently down a bit this morning. Last check, I saw the NASDAQ futures were down about 40, 45. The Dow Jones futures down 125, S&P 500 futures down roughly 13 points. So all of that's in the 0.3 to 0.4 percentage range. But of course, that was 10 minutes ago. So one thing you can do at stock charts is you can pull up the symbol summary and get a real-time pre-market quote. And when I look at that right now, the diamonds, the Dow Jones Industrial Average down about 0.47%, so a little bit more than what the futures were showing 10 minutes ago. Spiders down 0.46%, and the QQQ down 0.56%. So looks like we're going to get off to a weak start. I think part of the problem maybe is a little bit of uncertainty with the election yesterday. They're still saying the control of Congress is still unclear. This sounds familiar. Saw this a couple of years ago, and I just don't think the market, likes the uncertainty. It wants to know one way or the other what's going on. I think the longer this lingers, the worse it would be for the stock market. But there's a lot of earnings news. There's lots of other news going on out there as well. We also have not futures, but we have the 10-year Treasury yield right now, which is up. Let's see if I can get that for you. Yeah, 10-year Treasury yield right now is up 2 basis points, 4.15%. So rates are up a little bit. We got a big inflation report coming out tomorrow. The CPI for the month of October will be out tomorrow morning at 8:30. Could be some selling ahead of that. I mean, there's lots of reasons why it could be down. So I'm just kind of speculating. But the morning does tend to be somewhat, you get a lot of whipsaw, a lot of manipulation in the morning. So I really don't pay too much attention to what's going on before the market opens. I pay much more attention to how the market closes. All right, let's go ahead and get things going here. For those of you that are new, I want to mention a couple things over at our homepage. You go to earningsbeats.com. First of all, 3 days until our fall special begins. This is our biggest sale of the year. It will begin on Saturday. Those of you who are currently members or thinking about becoming members, this is a great time to get on board and extend. From a monthly perspective, this is the cheapest our service is ever going to be. You can, in the past, what we've done and what we'll do again this year is we'll have periods of time that you can extend, and the longer you extend, the more free time you'll get. So check that out. That'll be coming up in a few days. If you are not a member currently, this is a great time to do a trial, simply because you get your trial, some of your trial period, to decide whether or not you want to extend, whether or not you like the service. So you can check it out for free. And then if you like it, you can take advantage of our best deal of the year. It's a really good combination. One question we get all the time is, what about if, we have a 30-day trial and in 2 weeks, the fall special ends? Do we lose the rest of our trial if we decide to go with the fall special? And the answer to that is no. You get the rest of your trial, you'll get your 30 days, and then whatever you sign up for on the fall special will be added to it. So don't worry about that. You'll still get your full 30-day trial. It's a great time to try the service. Next up, if you're not interested in the paid service, make sure you're signed up for the Earnings Beats Digest newsletter. It's our free newsletter. No credit card required. You can unsubscribe at any time. 3 times a week newsletter, Mondays, Wednesdays, Fridays, always out in the morning. We try to get it out about 8:30 in the morning, an hour or so before the stock market opens, so that you can have time to digest it. It's very, very easy read, usually 2 paragraphs and a chart. And normally it's focusing on the things that are really important to us, including earnings, relative strength, candlesticks, price volume, moving averages, trend lines, all of those types of things. So check that out. Name and email address, all it takes. You can unsubscribe at any time. One big benefit to being in the Earnings Beats Digest subscriber is that when we have free events, we will reach out and give you room instructions. So, if you're not a Earnings Beats Digest member, there's no way to get into our events, these live events. So it's a great way to further your education, maybe take a look at things from a different angle. You may not agree with me sometimes. You may not agree with me all the time. I don't know. But hopefully I give you an interesting perspective, something to consider. And this is just one more way to increase your learning and at least maybe think about other perspectives. All right, yesterday, what happened in the market? Well, Dow Jones Industrial Average up 334 points, S&P up 21, NASDAQ up 51. Look at on the percentage basis, though. Dow Jones up more than 1%, S&P up just a little over 0.5%, NASDAQ right around 0.5%. The Dow continues to outperform. Look at this move off of the end of September low. Look at what the Dow has done. And here's the end of September low on the NASDAQ. And look what it's done. It's basically flat while the Dow has been soaring back to the upside. Part of that, I think, has to do with the fact that rates have moved up, which they're more, they hurt the more growth-oriented NASDAQ. That's number one. Number two, seasonally, this is a good time of the year. We tend to see areas like financials and industrials do very well in the fourth quarter. Well, financials and industrials, when they're doing well, the Dow tends to outperform. So anytime you get that kind of leadership, which we normally see in the fourth quarter, you're going to typically see the Dow move higher. The other thing is the dollar's kind of backed off a little bit. Dollar was moving straight up. The dollar impacts those multinationals a lot because the foreign earnings get translated back in at a much lower rate when the dollar is strong. So the fact the dollar is coming down is also putting more folks into the Dow versus the growth-oriented NASDAQ. There's a lot of reasons for it. I believe they're short-term reasons, but they are reasons nonetheless. And that's what we've been seeing. Mid caps up about 0.2%, small caps 0.1%. They've also been pretty strong on a relative basis. Everything's been down this year, but on a relative basis, the last 6 weeks or so, we've seen some pretty nice relative strength in mid caps and small caps. Looking at the sectors, most of the sectors were up yesterday, led by materials up 1.72%. Technology had a nice day, up almost 1%. There are your industrials right there at 0.9%. Utilities, 0.7%. And then on the flip side, lagging yesterday were the discretionary stocks, down about 0.25%. So mostly higher yesterday, but not everything was up, that's for sure. Moving on to the 10-year Treasury yield, not a lot out in terms of economic news, but currently we do see the 10-year Treasury yield at 4.16%. So now it is up almost 4 basis points. It's sitting in the middle of a range right now. I'm going to say, we'll use the inspector there. Right now, 4.33 was the high back on October 21st. Since then, we've come back down and established lows around 390, 391. So that is going to be the downside. I'm going to say we're going to be in that 40 basis point range until we're not. I mean, you have to respect the uptrend. You also have to respect the negative divergence. Which one's going to win out? Don't know. We're going to find out. And tomorrow morning may be our biggest clue because that's when the CPI report comes out. If that's hotter than expected, I would assume that most folks are going to sell bonds, get out of them, sending the yields higher again. If the numbers come in better than expected tomorrow, then I would expect the opposite. I would think folks to buy bonds at these higher rates, lock in, and that in turn, the buying will start to send the yields lower. But that'll be a big report over the last 3 to 4 months. The Fed meetings and the inflation reports, especially the CPI, that has been really that's been a difficult hurdle for the stock market, especially growth-oriented stocks, which you're going to find more of on the NASDAQ than you are on the S&P and especially on the Dow. Anyway, that's where we stand right now going into today's action. We'll see what happens. I want to give you a little different perspective today. on the S&P 500. You know, we're always taking a look at the S&P 500. This is going back 50 years. And what I've done is I've looked at the market on, I've put two panels in here down below. This is a weekly chart, by the way. And so I've got a rate of change for 52 weeks, which is 1 year, and a rate of change for 104 weeks, which is 2 years, just to show how, trying to think of the right word. It's not manipulation, but just the stock market isn't always priced perfectly. We know over time that the stock market goes up roughly 9% a year. That's been the average since 1950. So what I did is just to show you that, you know, one thing that really hurt us going into 2022 was the fact we went up so much heading into 2022. It's like, you know, we're returning back to the mean reversion, you know, if you will. But here you've got the S&P 500 going up, and you can see some periods, there's the late 90s, we were just shooting higher. And then, of course, early 2000s, really throughout the 2000s, we went nowhere for 12 years, zero. I mean, there was a top, and it took us till 2013 to break out above it. So you go through periods where you have lots of strength and you do much better than 9% a year. And then you go through periods where you catch up. You go back to it's that mean reversion. And so you get zero or you go down for a while. This down here is the 52-week rate of change. So it just quantifies, shows you on a chart the ups and downs in terms of 1 year returns, whether they're above average, whether they're below average. Now, 9% would be the average. If we went back the last 50 years, we could have drawn a line right there at 9%. Let me go ahead and do that. Go ahead and annotate this. Put in a vertical line. We'll make it a big, thick black line. We'll put it in here right at about 9%. Same thing over here, 9%. Okay. So that's actually, no, on a 2 year be 18%, my bad. So somewhere right about in there. All right, so this is kind of the middle. And you see how we just kind of go up and we go down, we go up, we go down. Well, back in 1983, you can see we shot up on a 1 year basis, went up over 50%, close to 60%. Coming off of this cyclical bear market low. And usually the biggest moves we have in the market to the upside normally come out of significant lows. So there's one in 1982, and then we had a surge coming out of that. If you go back, 1993, 94, we just weren't doing much of anything. And this surge in the late 1990s took place after about 3 years of going mostly nowhere. Well, 2 years. And then we had this huge surge. We were up way above that 9% throughout almost the entire 5 year period, which led to the secular bear market, where we had a huge drop. And you can see a lot of time spent below that 9% level, catching up. And then we go back into a secular bull market. And we have some up years. I mean, we had 2010. 2010, where'd it come out of? The bottom. So once again, here was a big surge, but it was coming off of a bottom. So a lot of this was just panic. And you get that it's the early surge that drives the market back to the upside. And you can see it there, 65% in 1 year. I've said before, when we bottom, the stock market's biggest move is going to be in the year following that bottom. I mean, if you come back down here 2021, or come over here to 2021, 1 year was up 70%. That was the highest 1 year return since, well, in the last 50 years. It came out of the pandemic. So after we had already gone down 30%, well, this is 1 year, but we had gone down 30% in that 4 week period, 35% actually. From that bottom, that's where we made this huge move to the upside. These types of moves are not sustainable. You can't go up 70% and then expect the market to go up another 30%. and then another 30%, and then another. Market doesn't work that way. Another chart I'll show you, this is the GDP. So what I did is I did a quarterly GDP report. It's dollar, sign GDP is how you get this on stock charts. And because the GDP comes out quarterly, I did a quarterly chart, set it up quarterly. And then down below, I have a rate of change over 4 quarters, which essentially gives us the GDP for a year. And if you look, the GDP is mostly contained in this range. We go 70s, we're a little bit out, above this range. We had these bear markets, we had the pandemic, we had the financial crisis where we went significantly below this range. And then, of course, we had the huge rally because the GDP was so weak in that first quarter of 2020 that we had this huge surge coming back out of it. And that's why we're way up here. But we're returning back into the norm right now. But if you look, the norm is somewhere in the 3 to 9% range GDP over the course of 4 quarters. And then if you throw in inflation of 2%, 2.5%, whatever, the average right in here is probably what, 5.5%, 6%. But then you throw in inflation, and it kind of brings you up to this average return over here of 9%. So my point here is that you've got to be careful about assuming too much from the market. You can't expect too much from the market after you make these big moves. Look at the 2-year return. 104 weeks, 2-year return. After the March of 2020 pandemic, March of 2022, 2 years later, we had gone up almost 100%. And if you look at the chart, where were we down here? 2191 was our low. So in March, we were somewhere around 4,300, which was almost double that 2,200. That's where this almost 100% move came from. Back in coming out of the financial crisis, our first 2 years, we had a similar type of a move. And then we went right back down into this range near zero. It's a reversion to the mean. Look at what we did and where we come back down to. Reversion to the mean. Look at what happened here, where we came back down to. Here, of course, that led to the secular bear market, 2001. So it wasn't just a trip down to here. But you can see, we get down here, we start to make our way back up. We strengthen again. Here we came back down into this range, started to strengthen again. Into the range, strengthen again. Into the range, went a little bit below because of the pandemic. Strengthened again. Now we're back down into this range and starting to try to strengthen again. So I just wanted to show you from a different perspective that one reason why the stock market is down this year is because it was unsustainable. The amount that we went up the last 2 years, you just can't keep going up like that. You need a period to pause. And this period's been great in one sense, in that it's allowed sentiment to reset. Everybody's bearish now. My gosh, you can't find anybody who thinks the market's going up. I'm one of the few. I'm out on that tiny little limb that's trying to crack. There aren't too many people bullish. But honestly, that's the way I like it. I like everyone to be bearish. I hope everyone has sold that wants to sell, or maybe they're, borrowing to sell. I don't like to see anyone lose money, trust me. But at the same time, this is how market bottoms form. You've got to go through these periods. Now I'm going to give you a little shorter term look. So this is just the last week. And of course, that's the first week basically of November. But you can see what's happened here in the last week. This is since last Wednesday's Fed meeting. Okay. So that's why I wanted to pull up this 1 week. Last Wednesday, we're going into Wednesday. So this takes care of Tuesday, last 2 days, Monday and Tuesday. And then the last 3 days of last week, Wednesday, Thursday, Friday. And of course, the Fed announcement came out on Wednesday and we had the selling. So this is what has happened since the Fed announcement. Materials, industrials, energy, financials, consumer staples, healthcare have led to the downside. The three big areas to the downside: technology, communication services, consumer discretionary. Growth. The Fed has once again put the kibosh on growth stocks. Will it last? I don't know. If it does, it's not good for the market because this represents a lot of the S&P 500. But go back and look at that S&P 500. I'm just going to pull up a short-term chart on it. I mean, if you look at the S&P 500 over the last week, we've basically gotten back to where we were when the Fed announced on the S&P 500, that is. That's, I mean, that is somewhat bullish. I mean, I don't like the rotation, but if you had told me that the Fed was going to come out with the announcement they did, and you said that the three groups that were going to be leading to the downside would be discretionary, communication services, and technology, I would have said we're probably at a new low. We're going to find out what this market's made of tomorrow, starting tomorrow, with another key inflation report. Now, I wanted to point out the industrials and the financials because they've been outperforming, and of course, the rotation hasn't looked great. But I also want to point out that when you look at the industrials, this is the last 10 years relative to the S&P. I've been going over this a lot, but for those who are new, I want to make sure everybody's up to date. October, especially November, look at the industrials relative to the S&P 500. It's outperformed 9 of the last 10 years. And we could actually drag this back and go 13 of the last 14 years. Industrials love the month of November. That's a pretty strong seasonality tendency. So when you see industrials leading last week, we shouldn't be too surprised. This is what industrials do. Financials. Over the last 10 years, since we broke out in 2013 above that double top from 2000, 2007, since that time, financials love the fourth quarter. October and November. Look at November's average outperformance over the last 10 years, 2.1 percentage points. October, 1.1%. Nothing else is even over 1%. September, 0.7 is next. So these 3 months, and throw December in there. December's not bad in terms of average outperformance. Financials tend to do well this time of the year. This is what the market normally does. It rotates more towards financials. Then you go and you look at technology. Technology relative to the S&P 500 does okay during the fourth quarter. November is relatively flat. It normally just kind of goes along. It's not your normal leader during the month of November. And if you look at the fourth quarter here, technology outperforms by a total of 1%. First quarter, it's 1.7%. I'm adding these three numbers together. 1.7%. Second quarter is 1.2%. Third quarter is 2.7%. Fourth quarter at 1%. This is historically the worst quarter for technology. Discretionary. Fourth quarter, the average return is down almost 1%, 0.9%. November shows a little bit of relative strength, but the fourth quarter is typically down versus the S&P 500. First quarter, up 0.6%. Second quarter, up 0.6%. Third quarter, up 2.1%. I'm talking about up above the S&P 500. Not that this is what the XLY goes up, but this is what it goes up over and above the S&P 500. First three quarters are all positive. Third quarter is very positive. Fourth quarter is negative. What we're seeing in the market right now is typical of what we generally see in the fourth quarter. Industrials and financials lead, technology and discretionary lag. Now, the extent at which they're lagging, I think, has something to do with the news of the day, the higher interest rates, the inflation, the Fed, the potential recession, the earnings reports that have been coming out. I think that also is clearly adding to the weakness. But keep in mind, historically, this is what happens in the fourth quarter. Moving on to earnings. We got Disney reporting, so let's get a quick update there on what's going on with Disney pre-market. Down $9 to 90.60. It's all the way back down here at these lows. Can we get a big reversing candle? Big hollow candle today? I don't know. Was not a good report, and Disney suffering the consequences today. Occidental Petroleum. Now, this is in a much better area in the energy space, but it too was hit. Well, this was hitting resistance. I think this pullback back down here close to the 20 days probably buyable. I wouldn't be surprised to see Oxy turn higher later today off that 20-day test. In the auto space, Lucid. This is stock down 7.5%. Autos have been really weak of late, including Tesla. Tesla getting close to a 2-year support low, though. If I have time at the end, I'll try to show you that last. Akamai reported last night after the bell, and they are relatively flat. Let's see what else reported. Software company Norton LifeLock, NLOK. Probably typed something wrong there. Or maybe not. Maybe just look. Oh, they changed to Gen Digital. That's right, GEN. So the stock down about 0.5%. But I mean, you can see we're down battling this support area closer to 20.5, 23's resistance. Need to try to break out of that range. Till we do, might be a little struggle. A couple more minutes till the market opens. Let's see what else we have here. Oh, AXON. This has been a stock that has been doing extremely well, and it's up another 7.5% today. So this is in the defense area. Huge move up. Had a breakout. I'd really like to see a pullback. Now it's gapping up with its earnings. I mean, it's a great company at some point, or a great chart, I should say. But at some point, we're going to get a big pullback on this one. I certainly would not be chasing the move to the upside, although this has been a very, very strong stock over the last 6-7 weeks. Plug Power in the renewable area, up 4%. This one, even though some of the renewables have been performing pretty well, Enphase Energy, First Solar, Solar Edge had a big move with its earnings. Not really seeing that in terms of Plug Power. Some support down here around $13, $14. We'll see if that holds, at least through earnings it's holding as we get ready to open today. This morning, let's see, were there any big reports this morning coming out? DHI, DR Horton, a home builder, up 1%. Look at the home builders. I thought this was supposed to be a horrible market. You know, the number of the new homes, existing home sales, all of this has been going down for a long time. Yet we're seeing strength in DHI and in home builders. Let me show you something pretty interesting. And then I'll show you the, let's pull up the Dow Jones US Home Construction Index. I mean, if you go back the last 20 years, notice November, December, and January. Home builders outperform during those 3 months by 6.7% over and above the S&P 500. So if I get rid of the S&P 500 there, and let's just look at it, So this is just what they do over the last 20 years. Look at the 2.5% average return, 3.2%, 3.3%. Would you think that in the heart of winter, home construction would have its best performance? Well, that's the case. I mean, that's what we got. And so DHI comes out with its earnings up 1%. Be careful. I mean, watch for a breakout. This is a pretty strong area recently, or certainly DHI has been strong. Trade desk. See what trade desk is doing this morning. The market just opened, I guess. So trade desk, nice little pop up about 8% this morning. Still got overhead resistance near 50 and that 20-day moving average. Got to deal with that. And then I wanted to show you Tesla. Let's just wrap up the show with Tesla. And I want to go back 2 years because and then we're going to take a look also at, we're going to use this inspector button because back, in March of 2021, Tesla got as low as 179.83. Low close was 187. Here in May, we had an open of 184. So we've had a close of 187-ish, an open of 184. Those are the two lowest candle bodies since back in late 2000. I mean, going all the way back over here. Okay. Look at where we went to yesterday and the day before. On Monday, we hit a low of 186.75. Yesterday, 188.13. We closed at 188. Or no, I'm sorry, that's today. Today, right now, we're at 188.28. I mean, we are at the support level. I mentioned to members yesterday that I took a position in Tesla, and I had a question come in. Why did you get into Tesla? What's the reasoning? Well, this is one part of the reasoning right here. It's at a major support level. To me, as I've said many, many times, there is nothing more important to me in technical analysis than price volume, the combination. We are right at price support. I mean, it doesn't get much better. That's number one. But there is a second factor here. Look at the lower low and the higher PPO. What we need is a false breakdown and a reversing candle. And if we get that, I will have a full position in Tesla, looking for a move back to the 50-day moving average. Now, the recent high was in the 230s. I think if we get what I'm looking for in terms of a rebound in Tesla shares, we could get back to into the 230s. Just a short-term bounce. I mean, here was 3 days. The stock went from 200 to 260, maybe 207 to 260 and change. It can happen, especially with a positive divergence. So anyway, that's why I like Tesla. Otherwise, and I'm talking about a short-term trade here, Tesla does not look good. I like it because I can keep my stop fairly tight. If I close below 184, 183, I'm out. I mean, this isn't, buy and just hope. I mean, I have a support level. I have a threshold. But that's what I see in Tesla. Major support along with a positive divergence. What I'm looking for to confirm it, volume's picking up. I think we're getting a lot of panic in Tesla right now. And what I'm looking for is a big reversal to show me that market makers began buying. Because if you go down in the low 180s, nobody's buying at this point. We will have broken below these prior lows. People are not buying. The only way we reverse is if market makers use their capital to accumulate shares in a breakdown. So that's what I'm looking for on Tesla. All right, let's go back to see where the market is. We're now, 4 minutes into the market. Dow down 229, S&P down 30, NASDAQ down 109. On a percentage basis, you can see the NASDAQ down. The VIX barely up again. This is just so strange. It's telling me that the fear in terms of market makers pricing options, when the market's going down, the option prices, the premium you pay on options goes up. The fact that it's not going up is telling me that this market doesn't have much downside left. That's just one signal, and it's a secondary signal, but it's a sentiment signal. We also have the equity only put call ratio, which has been elevated, another sentiment signal saying that we were too far stretched. Too many people are buying puts. I'll tell you what, right now, we've got a stretched rubber band. If the PPI or CPI tomorrow is less than expected, I think we'll see a massive rally. We'll see. I don't know. I don't know what's going to happen, but we'll find out then. Anyway, that's it for me. Everybody have a great day. Happy trading.